Hello, folks. I'm excited for this opportunity to spend a few minutes and prepare you for the information John is about to share. It's imperative you listen carefully and make sure you take notes as you go through this so you can understand how John and Pete do what they do. He's going to cover a lot of information, and what to him is very simple and obvious may not be to the rest of us. In this video, John gives you an inside look at how he and Pete developed their proprietary approach to the markets. This approach has not only made them two of the premier options traders in the country, they've also taught it to others who have had amazing results as well, many of whom have followed them for years. You tend to stay with a good thing. So often in investor education, so-called gurus claim that they have a new approach to trading that will give you an advantage in the market, when in fact, all they provide is a simple technical tool, or a list of rules or way of analyzing charts that works, sometimes, or for a while, until it doesn't. Have you ever wasted money on those kinds of things? Well, what you're going to see in this video is that John and Pete really do have something that could make all the difference in your investing. These guys have decades of experience in various aspects of the market. They've been successful floor traders, market makers, option specialists, and they built multiple hugely successful businesses, all having to do with trading. In any field, there are lots of educators who clamor for your education dollars, touting their ability to give you an edge. However, those educators fall into a few categories. First, those who've studied the subject just enough to teach it, but who have no real practical experience. Second, those who studied it have very narrow experience and maybe limited success. Third, those who are the best in their field. John and Pete are some of the best in their field. I mentioned they have decades of experience. Specifically, John has over 37 years of experience in options trading and education. In 1981, after a brief career with the Chicago Bears, he started at the Chicago Board Options Exchange. He was a floor trader for over 20 years. In 1990, he founded the market-making firm Mercury Trading, which was acquired by Citadel in 2004. Pete has over 26 years of experience in options trading and education and is one of the top 100 traders in the country. He started his trading career in 1992 after a career in the NFL where he played for the Tampa Bay Buccaneers and Minnesota Vikings. He's also been a commentator on ESPN. He started trading as a floor trader when he joined his brother John in '92 at Mercury Trading, and he eventually rose to become the president of that company. Together, John and Pete co-founded Option Monster in 2006, an option news and education site which was described by Security Industry News as content king of the option business. In 2006, they co-founded the online brokerage Trade Monster, which for years was rated best for option traders by Barron's. Both Option Monster and Trade Monster were merged in 2014 with online brokerage Option House in a transaction with a private equity firm. The merged entity was sold to E-Trade in 2016. They recently co-founded Investitute, an investor education company. John has authored or co-authored 4 books on options, and Pete has co-authored 3. And let's not leave out, they are the go-to guys for option trading on CNBC's Fast Money and Halftime Report. And their unusual option activity segment is the highest rated segment on the network. They're not some no-name claiming to have an inside scoop on the market. These are guys with stellar reputations and a habit of succeeding. They are disciplined in everything they do, including their desire to give you the best possible education and to give you the best chance at becoming good at this. With that, I'm going to turn it over to John. I'll be back at the end to give you some important information and next steps, so stay tuned. Here's John.
Thank you, Mark. And folks, thank you for joining us today. We're going to be identifying the ways that people found trades before we came up with our methodology, as well as, of course, explaining to you how we analyze unusual activity and how we use that to follow the smart money. We're also going to go through our frame methodology, which will give you guys an idea of how we enter the trade, how we manage the trade, and of course, how we exit our trades. So I think you're going to find this extremely interesting. And again, thank you folks, and thank you, Mark. We're ready to roll. All right, let's take a look at the old way, finding trades exactly how most people had done it prior to us coming up with our heat seeker algorithm and our ability to follow the smart money. The secret to a successful trade, many people thought, was fundamental analysis. And fundamental analysis, folks, means what does that company make? How many of these widgets do they sell? What's their profit margin on those widgets? What kind of guidance do they have going forward about what the demand is for those widgets? All that sort of thing would fall under fundamental analysis. Exactly how much money does that company make? How can you compare it to other companies in the same space through PE or other methodology? And that basically is all fundamental. And then you have technical analysis. Pete and I like to joke that every ship at the bottom of the seas was loaded with charts. Well, that's not quite true. And to the point of the folks that are really good on technical analysis, or TA, they would tell you that if the pilot of that ship, the captain, were to actually pay attention to the charts, he or she wouldn't have sunk the ship, which is also true. What we look at as far as technical analysis is we believe it is a guide that can tell you where you should expect resistance to the upside, support to the downside, as well as the potential for breakouts. In other words, if a stock has been basing over a long period of time and then suddenly is starting to get a surge of volume as well as a break of the 20-day, 50-day, 200-day moving average, those are useful tools. And that's all part of technical analysis. And then we, of course, have to look at how to accurately identify the best or the right opportunity in the market at any given time. Now, we believe that unusual option activity gives us an indication of the size of the movement that's expected, because with all of this that we've looked at so far on the old way of analyzing trades, fundamental analysis, technical analysis, and so forth, they're not giving us the exact time frame. When somebody trades an option, that option has an expiration. So that in and of itself is a time frame for when the person that bought that option is expecting that stock to move by. Also, they're giving us a strike price. Is it an at-the-money strike? Is it an out-of-the-money strike? Is it a way out-of-the-money strike, which looks like it'd be ludicrous for a big institution to trade, when in fact that big institution is basically playing for a takeover or something that would cause the stock to move 15, 20, 25%, those sorts of rapid movements. So that's the real, I think, the secret sauce in unusual option activity is there's so much more that's identified in unusual option activity than is possible through fundamental analysis or technical analysis. And that is what we're going to review today. All right, so let's take a look at unusual option activity as we define it, which is more or less a third way of finding opportunities in the market. Now, we more or less developed this when we were floor traders, Pete and I, on the Chicago Board Option Exchange. We were market makers and we were also specialists. So an option specialist means I have to make a two-sided market. And Pete was down there on the floor supervising 55 traders, making sure they knew where they were at any given time in the market as far as how long are we, how short are we, how directionally we could get hurt as a trading firm if indeed the market takes the opposite turn that we're not expecting. So what we're looking for is direction and timing. And as I've told you, if you take a look at options, they're giving you direction. Is the call above the market? Is the put below the market that they're buying? And the timing, that is the expiration. Are they expecting a big movement, or are they simply looking to tag along and follow the stock, which an in-the-money purchase would indicate it's not going to be as big a movement? Because believe it or not, folks, Pete and I aren't in it for 5 and 6% moves in the underlying stock. We're in it for that 5% move, turning our option into a 2, 3, or 400% improvement in our invested funds. That's what we're looking for. So we're really playing for those big moves. And so when we see people buying an in-the-money call or an in-the-money put, that's giving us an indication, but it's not an indication of a big movement. So as far as accuracy and frequency, accuracy, we try to improve it constantly. We're always trying to throw a new twist into it because the frequency is every day. So we get to basically look at these trades on a daily basis and find out what did we do right, what did we do wrong, so we can increase the accuracy of these readings. So that's something that's critical, is that this isn't something that's just written in stone and put aside. This is something that we're constantly massaging to make it better, to improve on that accuracy of our readings. So basically, we took our floor trading and our specialist experience and formed the Heat Seeker, because we would see large trading firms coming in and they would try to accumulate a large amount of options back when they had brokers that would actually step into the pits. We would see them stepping into the pits and bidding for a certain option class that was 5% out of the money, 10% out of the money. And we know that these people are looking for a large move, and they're looking for it very quickly. Now, back in those days, we could actually even identify the firms. I won't call them out by name, but the big investment banks, when they came in buying blocks of call options or buying blocks of put options. So that is something that we basically put into our methodology, is when somebody thinks they know what's going to happen in a given stock, they're going to buy a lot of something. If you knew that a stock was going to be taken over tomorrow for 20% higher than it is right now, it'd be great to buy the stock and make 20%. That's wonderful. But if you buy an option that's just out of the money, you could turn that into 400%, 500%, or higher, just because the options are going to increase in value much faster than the stock. And folks, one of the things I'd like to dispel is people see these large accumulations and they think, oh, it's got to be insider trading. No, it doesn't. People that run these large hedge funds, trading desks, and so forth, they're paying for market moving information that you and I just can't afford, or that we don't have the systems in place to take advantage of, whether it's algorithmic trading, trades that, for instance, go off in a fraction of a second when an algo reads a news headline that they've paid as much as $25,000 a month for that headline service that comes out just click, just that much faster than it's posted and the human eye can read. If a human takes 0.6 of a second or 2.5 seconds to read something, and an algorithm can read it in a millisecond, who do you think is going to move faster on that information? So the information does not have to be insider. It can just be very exclusively offered to people who have a lot of money, and they're buying it from reputable sources. They're buying it from S&P 500. They're buying it from the Conference Board. They're buying it from Reuters. These are all legitimate news services, but they have computers that are reading it much faster than you and I can, and in many cases, they establish a position in just seconds. Those are exactly the sorts of trades that we want to piggyback on, folks, because we know somebody out there is paying an awful lot of money for very fast access to market moving information, and whether it's offered in millisecond time frame or whether they've just come out of a conference and heard something that they thought was extremely positive in that conference. We want to be able to follow and coattail with those folks, because we know they have the ability to send a team of analysts to every conference, whether it's healthcare, whether it's technology or whatever, and we want to piggyback on that unusual activity. So exactly how do you follow the smart money? Well, there's that flow of information that I just discussed. Flow of information means that, again, there are going to be people in the back of a conference that's going on in San Francisco about healthcare the first or second week in January every year. And as soon as some news breaks there, or at the American Society of Clinical Oncology, ASCO, that goes on in Chicago, there's going to be somebody flying out of that room and posting up something to a website or sending out a news headline that an algo is going to respond to. So that flow of information is critical. And then timing and the quality and access to that information, again, those are things that folks, quite frankly, unless you're willing to pay $25,000, $50,000 a month for just the access, forget about the IT spending you'd have to be able to have a bunch of linked servers to get your trades into the floor at the speed of light. You just, and I just can't compete against the speed that these folks bring to their investments. The smart money, is it a hedge fund? Is it a sovereign wealth fund? Is it a large mutual fund even that has the ability to trade options and they're accumulating a very large position? Or is it somebody that's providing access to a very large trader like Warren Buffett or like Carl Icahn? When those gentlemen are buying derivatives, over-the-counter derivatives, those are not exchange traded, folks. So somebody had to provide them that access. When they do provide that access, giving Warren Buffett, for instance, a whole bunch of upside calls on Apple, and Warren is selling them a whole bunch of downside puts to help offset the cost of those calls, that person that provided that access needs to hedge themselves. We will see those footsteps in unusual activity because they will come in large chunks to try to cover themselves, knowing that Warren and Carl Icahn and Einhorn and anybody else who trades this way is frequently right, and they don't want to get run over, so they need to hedge themselves. So filtering and identifying the trades is critical to the success of traders, and how we define that is we see unusual activity and then we jump on those trades. That is the equivalent of our research and analysis. Our research is we're looking for the smart money, and our analysis is that they are buying these upside calls in greater numbers than we've seen over the past week, 2 weeks, 3 weeks, that this is unusually large accumulation of a just out of the money call ahead of a new product announcement, ahead of earnings, whatever it might be, even ahead of something that we have no idea what it might be. And the very next day, some news breaks and we say, my, that was interesting timing that they had buying those upside calls. So our analysis is we look first to see, do we know that there's something going on, like a new product announcement, settlement of a litigation event, or perhaps earnings report. And if there are, then we surmise, okay, that's coming in the next 48 hours. That's why they're trading such short-term options. So then we can coattail along with them. I'm not going to buy a 6-month out option if that's the kind of activity I'm seeing. I'm going to be right there with them buying those 3-day out options or buying the 2-week out options, whatever it might be. So our analysis is that we have to look at the trades and figure out why they're buying as best we can and then follow along with them. So the basic components, or the footprints, if you will, that we see of unusual option activity is usually something like this. Somebody thinks that they really like the upside of Apple, of Qualcomm, of NVIDIA, whatever it might be. They might be buying a whole bunch of calls very quickly. Sometimes they'll break up the trade. And since there are about 16 different option exchanges, folks, many of which are 100% electronic. In other words, there aren't any market makers on the trading floor. There's just a co-located server in a data center somewhere, and a whole bunch of trades just go off very rapid fire across all 16 exchanges. We know that's somebody doing something we call a sweep. They're coming in, buying a whole bunch of calls or puts very quickly. Now, they'll usually drive the price up dramatically when that happens. So we're looking, are they buying short-term options? Are they buying out-of-the-money options? Or are they buying, as far as open interest, much more than the previous open interest? Now, open interest is all the trades that have gone off since those options were listed. And for instance, if the open interest is 2,500 contracts, and all of a sudden we see 7,000 contracts trading, we know that's not just a short covering trades that they've already put on. This is somebody opening up new positions. That's what we're looking for, the volume to be larger, and in many cases much larger, many times larger than the open interest. In some cases, there's even no open interest. People have not even traded these options, and all of a sudden we'll see 5,000, 7,000, 15,000 options trade. That's an institution that wants to get fast exposure to 1.5 million share equivalent, because 15,000 options, since every option represents 100 shares of stock, would be 1.5 million share equivalent. You want to piggyback, I want to piggyback on that unusual activity, because it's telling me something about how soon somebody thinks it's going to happen and how big this potentially could be. Now, some of you might ask, well, why would smart money use options? Well, I'll tell you several reasons. One, it's easier to hide. Why? Because there are so many different strike prices. When you're trading the stock, you could go to Yahoo and see what the average daily volume has been over the past 3 months for a stock like FireEye or for a stock like NVIDIA. You could just go there, see what the activity is, and you say, wow, it's already traded twice the volume of the 3-month average. Well, how about in the options? First of all, few of us have access to how many options have traded in every single series of that particular stock. And when you're talking about a stock like NVIDIA, which is a $290 stock as of October 4th, 2018, when you're seeing a $290 stock, they might have strike prices down to 200, folks. They might have strikes up to 350 or even 400. When you've got that many different strikes, it's easy to hide volume. It's hard to see it. And then you get the leverage aspect of it. What if you think you know something about the stock going up 15 or 20% over the next 2 weeks? You want to leverage that. With an option, you get that leverage. So you want to buy an at-the-money option, you're getting basically 2-to-1 leverage. If you want to buy an out-of-the-money option, you might be getting 5-to-1, 6-to-1 leverage over owning the stock. And obviously, since options have a limited lifespan, you're also getting the kicker or the additional leverage of the shorter you push that to expiration, the shorter the amount of time to expiration, the more leverage you have, which can cut both ways. You either are extremely confident that something's going to happen in the short term, or this could be a total wash of the capital invested. So when you see somebody committing a lot of options with only 3 days to trade, you know they think they have the playbook for tomorrow today. Unlimited profit and limited risk is another reason, because with the option, you have defined your risk on entry. With a stock, you really haven't. You could buy that same NVIDIA stock at $290 a share. You have, let's say, not $290 at risk, but you certainly have $100 at risk if something bad were to happen to the stock and it craters and drops $100. We've seen those kinds of moves, a 30% move to the downside on an earnings miss, for instance. Well, if you bought an upside call and they had an earnings miss, you had a limited amount of risk in that trade because you could only lose what you paid for the call. And generally, my rule of thumb is if an option loses half of its value, I cut my losses and move on to the next trade. With stocks, that can be extremely painful. And you don't get the unlimited profit. I mean, the profit potential for an option can be 5-fold, 10-fold. I could show you multiple cases where that has been achieved. And with the stock, again, you make a 20% move in a stock, that's a home run. But with options, you could end up seeing, many times that return. But using certain option spreads and strategies, you can have virtually unlimited profit. We also see a fair amount of the really smart traders basically getting in there and establishing spreads, vertical spreads, bull call spreads, bear put spreads. They could be putting on butterfly spreads. They could be hedging. So it's up to us to determine exactly what they're doing with these multiple trades. That makes it even tougher to read. But it's, again, something that 37 years of experience for me and almost 30 years of experience for Pete. That's why we are able to do it, because we've seen these sorts of trades time and time again. It's also not always an unlimited profit potential that these people are seeking. These are smart money traders, folks. So when I say that they have unlimited profit potential, many of them are willing to trade off some of that upside by basically cutting off some of the upside by selling a call against the call that they bought. That doesn't mean that they're dumb. That means, in fact, that that's a really smart trader who is basically saying, you know what? If I can take and turn this move in the stock into a double or a triple, that's fine. Pigs get fat, hogs get slaughtered. I want to have the odds in my favor rather than always having unlimited profit. All right, so our heat seeker algorithm basically is constantly in the markets looking for trades that are unusual. Now, first of all, how do we get that information? Well, we use 6 1 gigabit circuits to the internet and one 10 gigabit circuit to the internet. Now, what is that? That is, folks, just as fast an internet connection virtually as is possible in most of the United States. So when you want real-time information, and by real-time we mean on a millisecond by millisecond basis, it takes about 16 milliseconds for a trade to go from Chicago to New York. Now that might not seem like a lot to you because obviously the blink of an eye seems very quick also. But we need to be right at the data center, pulling the quotes from the data center as these trades are occurring to be able to determine, was that really trading on the offer, or was it because the offer became the bid and the market was starting to roll over? In other words, the market was 55-cent bid offered at 57, and all of a sudden it became a whole bunch of trades occurred at 55. Was that somebody hitting the bid because the stock had rolled over, or was it somebody actually accumulating a whole bunch of calls at 55 before it became 55-cent bid offered at 57? Maybe they were 54-cent bid offered with a big offer at 55 and somebody had just stepped in. If you're seeing it a second later or 2 seconds later, you won't know the difference. But with our computer pulling that in real time, we're able to see that that was actually that 54-cent bidder stepping up to 55 and buying those calls. We use the algorithm every single day. It's by far the best indicator that we've ever seen, and this is why we cover it on CNBC every day. Unusual option activity on CNBC is one of the most popular segments of any show, and I guarantee you, if you're somebody that has been following us, you've been waiting for the time when we come on television and say, here's what we're trading today and here's why it was unusual activity. So what's the secret? Well, it's the heat seeker when we team it up with our frame methodology. You put those two together, that gives you the secret sauce. So to recap, what is unusual option activity? Well, we're talking about unusually large trade size. We're talking about blocks of options, not 10 lots, not 20 lots. We're talking about 200 contracts, 500 contracts, 5,000 contracts. That's what we're looking for, folks. If you're somebody managing a $100 million hedge fund or a multi-billion-dollar hedge fund, you can't afford to make 10-lot trades. Those are retail trades. Again, no disrespect intended, but those aren't the smart money that I'm trying to follow. We're trying to basically ferret out the biggest trades in the market where somebody with a lot of access to superior information has determined that the likelihood of this stock moving is high and the likelihood of it moving in what time frame. So that's why we're saying unusual option activity is large trade size, the valuation, it's inconsistent with regular pricing factors. What do I mean by that? Well, for instance, an at-the-money call should move 50 cents for every dollar that the underlying stock moves. That's what's known as a delta of 50. So what we're looking for is that at-the-money call moving at 75 cents instead of 50 cents for every dollar the underlying's moving? If that's the case, we know for fact that somebody in there is disrupting the pricing or the valuation of that option. And that will only be disrupted when somebody has a lot of size. And the market makers, whether they're electronic, in a data center, or in a trading pit, the market makers are simply not willing to sell anymore at the lower price. They keep offering a higher price, and then that big trade steps up and takes the higher price. So they're driving the option up faster than it should. That's a tip-off. So the time frame, if people are buying an option that's only out there 2 or 3 days into the future, and they're buying them in big quantities, and they're driving the price of those options inconsistent with what the model says they should be, again, that's somebody that thinks they have tomorrow's newspaper today. Smart money price is higher than the market price. Well, that's because they need to get that 5,000 contracts, 10,000 contracts to make the trade make sense for them. All of these signals say somebody believes a much bigger move is coming in this stock. And according to pricing models, which people have won Nobel Prizes for, folks, the pricing doesn't make sense. And that's because it's been disrupted by these large traders. So mathematically, the pricing is out of whack. That's another tip-off that smart money thinks they know something about the future price of that given security over the next day, 48 hours, 2 weeks, whatever the time frame is. And that's why when we see these traders buy large options in volume, they're willing to pay so much more for these options to establish the trade, and it's time critical information. So here's an example of our frame methodology. The F is for filter, and we're filtering using our heat seeker algorithm to find those potential trades, those trades that are larger than they should be under normal circumstances, the trades that are mathematically defying what the model thinks they should be, and so forth. So research. What is the reason somebody may be placing this very large trade? Could it be that it was unusual activity because of earnings, just ahead of earnings? Could it be that the stock sold off very hard and now somebody believes that it has bounced at a technical level and they're looking for it to retrace back up to that 200-day moving average, that 50-day moving average? We basically analyze all the various reasons that could be out there, and then we analyze the option market to find the best strategy, because we're in there looking for why did they buy this way out of the money call. Maybe the higher percentage return is that way out of the money call, but maybe the higher probability return is for us to basically buy a couple strikes lower and sell that higher strike. Because again, this game, folks, isn't all about hitting home runs. It's about getting hits consistently. So we're going to try to find the best strategy to make money once we find this unusual activity. And then it's making and managing that trade. So we make the trade and then we manage it by, as I've said many times on television, when I buy an option, if it loses half of its value, I'm cutting it off. I'm basically saying I'm going to cut my losses and move on. That's managing to keep from losing my money. On the other hand, it's just as important to manage your profit side of the trade, and many people don't do that. They think they can just let it run and then it might migrate all the way back down. You can't do that. So when I say manage your trade, that means you have to be as active on disciplining yourself to take profits as you are about disciplining yourself to take losses. And lastly, it's when do you exit the trade? As I've said, if it's not working and I've lost, in my case, half of the value of the option, you have to determine what's important for you. If I lose half, I'm out. On the other hand, if I'm making money on the trade and that 75-cent option has popped to $1.50, I'm taking off half and I'm letting the rest run. If it pulls back down after that recent pop and pulls back down to, let's say, $1.25, I'll probably punt the rest of it and exit the whole trade. On the other hand, if it keeps moving up, maybe I decide to sell the higher strike against that option and eke even more profit out of that trade. So again, frame means that we're filtering, researching, analyzing, making and managing our trades, and then exiting our trades. So folks, here are a couple examples. A recent example in Disney, DIS. It's obviously a favorite stock of many folks, including Pete and myself, but in this case, we identified some very bullish call activity. Somebody stepped in, bought 6,000 weekly calls. They were the 110 calls, and they were purchased for 86 cents, and then they ran them up 20 cents higher than that to $1.16. Now, the stock was trading at 109.05 at that time. So what do we know about this trade? Number one, large. They bought 6,000. That's 600,000 share equivalent of Disney. That's a big trade. They were weekly calls. That means somebody thinks that this stock is going to move right away, like bang, bang. Then they were spending 86 cents. So since each option is for 100 shares, that means $86. They weren't spending $109. They're spending $86 for these options for each one of these options. So, for instance, $109 times 100 shares, this is a $10,000 trade, folks. Meanwhile, you're controlling that for $86 for every 100 shares. Now, just a week later, these calls popped to almost $7 a contract, which, of course, if you figure that every option's for 100 shares, that's nearly $700. So you went from an $86 investment to nearly $700, 8 times the initial purchase price, and the stock had moved up to $1.16. So it's wonderful to have a stock almost to $117. So you've had a stock that has moved up by about $7, almost $8 here. That's fabulous. How'd you like to have that 86-cent option go to nearly $7? So Disney rallied after abandoning its pursuit of Sky. They did that because, number one, they're in there spending $71 billion for 21st Century Fox. So basically spending $15 billion more to buy a UK satellite broadcaster. The market said, we think you're smart to step away from that. So the stock basically popped by nearly those $7. So this is a perfect example of how options could be used in a forecast to take advantage of, for instance, mergers and acquisitions. So it doesn't mean it's insider trading, folks. It means somebody smart said, are cooler heads going to prevail within the boardroom? They're spending $71 billion. Do we think they're going to step away from Sky? And if so, can I take a very small risk on a weekly call at the 110 strike rather than buying the stock at 109? A stock that if they completed the Sky bid might have sunk back down to $100? Well, I think we know the answer, and that's why whoever the smart money was led us into this trade. Here's a second example. This one's from August 23rd on the Heat Seeker. We saw bullish call activity, weekly calls again. The 15 calls were purchased for 34 cents. They paid up another 20 cents in this case. 2,400 of the weekly 1550 calls were also bought, as you can see, from 18 cents to 29 cents. Now, that same afternoon, the stock popped by 7%, and the calls went up 400% and 600%. In other words, that initial purchase, $34 for those calls, 34 cents means $34, folks, versus buying the stock at $1,500. That's a huge potential leverage that somebody wanted because they believed the stock could pop. Now, again, the stock surged on the news that FireEye had helped Google and Facebook identify disinformation campaigns that were linked to Russia and Iran. So FireEye can help out two massive tech companies by basically finding this disinformation campaign that was attempting to disrupt whether it's elections or just news dissemination from Google and Facebook. Stock pops, and we participated. We rode on the back of that unusual activity. Thank you, folks. It's a pleasure to be with you, and that's a brief overview of what the Heat Seeker, our frame methodology, and our secret sauce, how that all comes together to help us identify the smart money and follow the smart money. Now, if you want more information on how to do just that with Investitute, Mark is going to give you some more information on how you can follow along with the smart money on a weekly basis or on a daily basis. Thank you.
Hello again, folks. Thanks for listening. This has been a crash course on unusual option activity. We produce this DVD because some folks learn better visually, and we want you to understand two things. First, we're talking about something that's real and that can actually make a difference in your investing. We're not talking about some magic indicator or a system that easily unlocks the market and rains down cash. I'm sure you've seen those kinds of claims that ultimately just waste serious investors' time and money. Second, we want you to understand that if you're serious about trading and you're looking for legitimate tools and education that give you a shot at becoming really good at this, you've found what you're looking for. Why does this matter? Because it's a fact that the majority of people will never have the secure lifestyle they actually desire. It's also a fact that the biggest reason for that is because they don't know how to grow their money properly. If you're currently contributing to a retirement account and you're behind on what you need to retire comfortably, It's a safe bet that the reason isn't contributions, it's rate of return. Wall Street has run a scam on the average American. They've convinced you that you should settle for single-digit returns, and that if you think you can do better, you're just dreaming. Well, folks, think about it. They have a financial incentive to keep you believing that, because as long as you believe it, you'll either have them manage your money, which they then turn around and leverage to make fortunes for themselves, or you'll trade it yourself with the expectation that you'll lose often and really shouldn't expect much more than mediocre returns. In that case, they're on the other side of your trades, making a killing. Either way, they win and you lose. Are you tired of losing? It's impossible to win a game if you really don't understand the rules and if you're playing at a disadvantage. Whether you're letting someone else, a so-called expert, manage your money, or if you're managing it yourself, even if you've been doing it a long time, we're confident that you can do better. As John illustrated, because of the way information flows in the markets, you are at a disadvantage. No technical indicator and no amount of fundamental research will offset that. Information is never available to all points in the market at the same time. It must flow to you, which takes time, and that time puts you at a disadvantage. There is only one way to overcome that, and that's to follow the smart money. Well, now you understand the concept, and I'm sure you can see it's for real. The question remains, will you put your head back in the sand and continue to be taken advantage of? Or are you going to learn everything you can about how to effectively follow the smart money? Hopefully you've made up your mind that you're going to do the latter. If you have, there's something else we need to talk about. Specifically, how do you implement this given your unique situation to meet your trading goals? Clearly, there's still a lot to learn. It's one thing to see unusual option activity, but as John illustrated, you then need to filter, research, and analyze it so you know which of it matters. And then there's still the challenge of knowing how to trade it. This is where so many investors get lost. The good news is we're not going to leave you hanging. I mentioned at the beginning I would give you next steps. If you're serious about this, the first step is to talk to somebody from our team. This allows us to look at your situation and help you determine how best to use this information to accomplish whatever goals you have in mind. Some of you will choose to just go this on your own and figure it out from what we've already given you. If that's what you're thinking right now, you're a brave soul. For the rest of us, the most effective way to learn and sharpen this skill is to have a mentor. Now, as important as that is, not just any mentor will do. It has to be the right mentor. Let me illustrate. When I was young, I played baseball. My older sister was dating a guy who thought he was the best at every sport he played, including baseball. She believed him, so she asked him to help me with my swing. Following his advice totally ruined my swing. I never did completely overcome the negative effects of his training. There are lots of folks who play sports, but you wouldn't necessarily want to learn from just any one of them. There are many people who have run businesses, but I've seen some pretty poorly run businesses. There are traders who have been doing it for many years, and even been floor traders. But believe me when I say, they're not all created equally. What we're really talking about here is your hope of finding a guide or a mentor to give you a leg up, to shorten the learning curve and help you avoid mistakes. So, just like in anything else, you need to make sure you're learning not just from someone who's done it before, but someone who's done it well. And if you're lucky, perhaps even someone who is the best at it. Even better, someone who's in the habit of succeeding in everything they do. Isn't that who you'd want to walk you through the learning process if you're serious about becoming exceptional at it? Of course it is. So consider John and Pete and honestly ask yourself the question, can I learn something from these guys? And are they the ones I should listen to when it comes to trading options? They are used to succeeding. If you've ever played sports and aspired to the pros, you know something about how difficult it is to rise to that level. If you've ever built a big business, you know something about how difficult that is. If you've ever aspired to be on national TV or become famous, you realize how few people accomplish that. Accomplishing even one of these things is impressive, but John and Pete have done all of them. If you've ever traded, you know something about how rare it is to get the kinds of results John and Pete get. These guys are used to succeeding. They are disciplined and focused. Now, the reason I'm bringing this up isn't just so you understand that they have the results you need in order to trust them as your mentors, but also to make clear they are serious about providing you the best possible opportunity to learn how to do this. And with their track record, you can rest assured that they've approached this the same way and have made sure they only have the best on their team so they can deliver world-class education. If you're serious about leveling the playing field and getting proficient at creating wealth, you've found what you're looking for. Reach out and have a conversation with our team to discuss your options. Go to learnfromjohnandpete.com Answer a couple of quick questions, and we'll have someone reach out and spend some one-on-one time. Or if you prefer, you can just call the number on your screen, 1-800-331-4555. Well, folks, that about wraps us up. If you have any inclination that you should have a conversation with a member of John and Pete's team, go to that URL right now while you're thinking about it. Don't just tell yourself you'll do it later, because the odds are you'll forget. We look forward to speaking with you. Until then, get out there and trade smarter.